Hero capital raising party. My name is Logan. If you guys aren't with us on Zoom, make sure that if you're watching us on YouTube, LinkedIn, Facebook, wherever you're watching, make sure you click that Zoom link. It's a lot more fun. You can introduce yourself. It's a lot more interactive that way, right? For those of you that are here with us on Zoom, make sure you drop your contact info in the chat. I'll call on you guys, quick introduction about, yourself, where you're from, what you do, and we'll get rolling. All right. We have Derek Zurcher. Do you want to introduce yourself?
Sorry, I just had myself on mute. Yeah, my name is
No worries.
Derek. Nice to be here. I'm an Australian living in Houston, used to be in the oil industry. Got laid off a while ago. Build townhomes right now, but looking to build a RV park, and I also have a marketing agency at the same time. So
Awesome. Well, welcome, Derek. Thanks for joining us. All
thanks.
right. We have Rachel Cohen, who is a brand new Hero Alliance member. Rachel, do you want to go ahead?
Yay! Yay! Hi guys, I'm Rachel Cohen, House of Kings Collective. I'm on here now. I'm actually raising for a property in Corpus Christi. So if you're interested, it's 100 units. Reach out.
Awesome. Great to see you, Rachel. Yeah, Rachel just joined our Hero Alliance, and so she's, jumping right into it. Welcome, Rachel. All right, Eddie Austin, you're up next.
Well, no, we skip Eddie because Eddie's the man of the hour
Oh,
today.
sorry.
So Eddie will skip Eddie.
I'm just going down the list. Sorry about that. Okay, we'll hear a lot from Eddie for sure. Victor Lopez.
Good afternoon. Thank you. Victor Lopez. I'm out of Fishkill, New York. I am a tax lien, tax deed investor. I will put my info in the chat. Thank you for having me.
Great to see you as always, Victor, recurring guest with us here. Awesome. All right, Eric Tomei. Hope I'm saying that right.
You absolutely are, Logan.
Awesome.
I'm Eric Tomei. Nice to meet everybody. I'm from the Metro Detroit area, and I attract capital for multifamily and industrial complexes, and I'm very excited to connect with all of you.
Fantastic. Welcome, Eric. Thanks for being here. All right, we have Randy Smith. Go ahead.
Yeah. My name's Randy Smith. I am the founder of Impact Equity, which is essentially a fund-to-fund manager raising about $7.5 million over the last couple of years. Also the host of the Gentle Art of Crushing It podcast, where we interview passive investors and operators as well. And then recently launched a capital raising coaching, one-on-one coaching program. So happy to be here and be in front of all of you guys.
Awesome. Thanks for being here, Randy. All right. Eliav, you're up next. Oh, you're muted, I think.
Of course I am. I'm a syndicator and operator, currently living in the Cayman Islands, doing mostly multifamilies in the southeast. We'll be happy to connect, and thanks for your tag today on LinkedIn.
Awesome. Thanks for being here. Great to see you as always. All right, Sheldon. Sheldon Baksh. Hope I'm saying that right.
Yes, hi, I'm Sheldon Baksh. I'm primarily based in San Francisco, California. I'm a real estate investor for the past 3 years. Been primarily doing fix and flips. I'm excited for the opportunity to, join your alliance to do funds of funds and possibly my own fund for real estate apartment buildings, and looking forward to this event.
Awesome. Welcome. Thanks for joining us, Sheldon. Great to have you here. All right. Yukiko, you're up next.
Hi, my name is Yukiko Nakayama. I'm based in Northern Virginia and looking to buy self-storage. So if anyone who has a self-storage or know someone who owns the self-storage, please let me know. I put my contact information in a chat. Thank you so much.
Awesome. Yeah, make sure you reach out to her for self-storage. Great to have you with us. All right. I think that's everyone. I see a couple people with their cameras on. I might call on and pick on a little bit. Hey, Keith, how are you doing? You want to introduce yourself? I see you there. Nope. All right. No worries, Keith. Just trying to find a few people with their cameras on that might want to say hi. Jonathan, do you want to introduce yourself?
Yeah, Jonathan Morfin with Action Restoration. We're pretty much developers. I am raising capital for 73 unit apartment complex, Class B in Port Neches, Texas. If y'all want to connect, we can connect. Great to be here. First time on here. Excited.
Awesome. Well, welcome. Great to have you here. All right. I think that's everyone. Anyone else want to introduce themselves really quick? All right. I think that's everyone. For those of you that didn't get a chance to introduce yourself, no worries at all. Make sure you stick around till the end. We'll put you into a breakout session, breakout rooms. You can do some networking, talk about what your superpower is, where you need help, that sort of thing. And make sure you guys download the chat. A lot of capital is raised and connections are made after this call is over. You download the chat so you can connect with everyone that you might have missed. And like I said, millions of dollars have been raised on these calls just from connecting offline. And I think that is it for me, Tim.
Awesome. Thank you, Logan. Well, hello, everyone. All right. For those of you who came in on late, I have some internet issues at my office today, so I'm on my phone, but we'll make it work seamless. Eddie, are you ready, sir? Okay. I'm gonna count us down, and we'll start. 3, 2, 1. Welcome everyone to our Hero Capital Raising Show. I'm your host Tim Mai, and today I have a good friend and an amazing guest on the line with us, Mr. Eddie Austin. He is a fund manager as well as a serial entrepreneur, has lots of experience in business and real estate, business in general as well as real estate. And Eddie has a strong passion for helping other people build wealth through real estate. And he currently has a 506c fund that was started in 2020 and already raised over 24 million for the fund. Eddie has managed companies with over $200 million in annual revenue, over $100 million in asset under management, wide range of knowledge. With that, let's give Eddie a big welcome, y'all. Woohoo!
Well, thank you all. And thank you very much for the intro, Tim. Much appreciated. Just happy to be here with you on this because it's an honor. We've met in conferences a bunch. We've talked a lot back and forth, and we're both definitely educators in the space, helping other people get where they want to go. And when I got the invite, I was happy to oblige and jump on and do this. So, if you want to ask any questions or let's just roll with it. Let's do an open mic.
Yeah, definitely. Yeah, well, Eddie, start with, if you can share with everybody a bit about your background and how did you get into this world of syndications and funds?
Yeah, absolutely. I kind of shock a lot of people because everybody says, why did you get in real estate? Well, to be completely honest, I was broke. Everything I did, the first thing I did was learn a skilled trade to make $100,000 a year. And my first thought process was to retire early, was, find a skilled trade that made $100,000 a year. And from there, if I worked double as much as everyone else, I would retire earlier. Well, that's not so correct. After taxes and everything else, that's not how it works. From there, I went into management. I learned management. I just learned more trades that made more money. And again, with the concept of working more hours than anyone else, I would make more. And, that was never growing the 401k per se. It was never building retirement for the future. Definitely wasn't going to retire me at 36. And from there, I decided that I was going to get in real estate in 2004. And my dad was always a boat builder, and he built houses as well. And my dad and I was building houses. And then I started fixing and flipping houses. And then, 2008 through 10 happened, learned a lot from that. And from there, I went into, kind of an entrepreneur. I went to built my own business. My first skilled trade was welding. So I built a metal fabrication shop, then a hot rod shop. And then, I bought a company and built a company. And, then I started realizing the power of, owning your own business and some of the freedoms you have and the ways you make money, and then understanding tax write-offs. So from that point, I got to about 7 companies, and I still wasn't where I wanted to be. And I was running a big solar company. I had the opportunity to run a Toyota manufacturing plant. And from that point, I'm like, okay, so all of these things, are not really in parallel. And how can I tie all of this together? And I knew what I really wanted to do. And that was, I wanted to be one of these guys that had a private jet. I wanted to be one of these guys that had all these things. Now I'm gonna stop right there and say, I've since changed that passion. It's not about the private jet. It's about helping other people. But, I was realizing what these other people had and how they got there. And I was very interested. How did they get to this point? How do they afford something like that? Well, they either own a business and scale it and sell it, or most of them have real estate. Even when they have a business, they're in real estate. So for 7, 8 years, I went down the rabbit hole and I learned everything you could learn at that time about how the wealthy get so wealthy. And it came down to real estate and other people's money. And how do you legally do that? How do you legally raise capital with other people's money and deploy that into real estate? And I had heard about syndication. My first one was like a joint venture, tenant in common, worked pretty well. Then I decided to syndicate. And honestly, syndication didn't really work for me. In the town I was living in, when I told people about syndication, they thought it was a Ponzi scheme. They really hadn't heard the term. They didn't really know much about it. Well, that drove me crazy because I had already had S Corps and I had already built bigger corporations and I worked for big corporations. And I was like, Blackstone does this. Why don't I have the same recognition? Well, at that point, I said, okay, so how did Blackstone do it? And again, back to the drawing board, started learning, and I figured out how to build a fund. So I was the crazy guy that called up a lawyer group and swiped my credit card and said, okay, let's build a fund, $20 million in size. And he said, okay, we can do that. And that was a learning experience. And there was a lot I didn't know. And luckily I had a decent following. And the very first conference I went to, an event that we've kind of put together, in that first fund, I was able to raise 24.6 million in one event.
Wow.
And when it come down to it, when I look at, how hard it is for other people and how hard it is for the current times, I had kind of built a runway is what I had done was, I'd kind of built a following. I kind of had a community together. People kind of knew what I was doing. I had professional people that was around me, and I had done a good job of telling people what I was doing and advertising returns and doing these things. That was the only reason that I was able to raise that much money that fast in the first fund. Now we have another fund out. It's $50 million in size. And this one, is doing RV parks, land, and multifamily all in the same fund model.
Gotcha. I'm curious. Okay, so the reason why you got into funds is because syndications wasn't working well, and you thought that, well, BlackRock is a fund, and so creating a fund is the way that you want to go about it. Was that your
That's
thought
it.
process?
Yeah.
Okay.
So I was not to cut you off, but I was in a small town. And when I was advertising this out, syndication was not your everyday at the dinner table term or use of a word or even realized. And I realized that as I expanded out my reach, it was definitely something that a lot of people do. But everybody that I talked about, there's like, yeah, well, I've heard of Blackstone. I know they raise money or whatever, but, they were kind of confused by it.
Okay, that's interesting. That's so, which is so opposite than what most of us experience, where it's so much easier to raise for syndication than it is for a fund. So your fund, your first fund there, was that a blind pool fund?
Yes, 506C. Now, see, that's the thing is I never really looked at it like a blind pool because I was involved in writing the narrative for this fund. So when I had wrote the narrative, it kind of is a clear outline. You knew exactly what I was going to invest in. You knew the city, you knew the state, you knew the MSA, you knew everything about those MSAs that we were going to invest in. You knew how the money was deployed, the type of debt we put on the property, how we were going to renovate. So I was very detailed in that PPM, your private placement memorandum. And I went through everything to explain, exactly what it was. Now, if somebody gave me $100,000, did they know the address that it was going to? Probably not. They knew I was an active buyer. And from that active buyer standpoint, they knew that my track record was, and my Bible was wrote that we were going to invest in this type of asset.
Right. Okay. I mean, give us kind of like a high level, pitch on your fund, on your first fund. I'm curious, what was your pitch that got, I understand we're going to talk about the community and, everything that led up to, to that pitch and the opening of that fund. But what was your pitch in the fund that have so many people interested?
So I think first, I would admit that I really dug in syndication on why people didn't like it or what was the downfalls of it. So I kind of armed myself and put things in my tool belt why people would invest with me with having a fund over the top of a syndication. And I used that to my advantage. So when I was at, events and stuff like that and conferences, I would tell people what I was doing. And I was like, I'm a business owner. And that's the thing I want to admit. I'd kind of, not chose to talk about the other business types that I had done because I felt like that would render my experience. And it turned out that actually it didn't. When I told people that I had a metal fabrication shop and a hot rod shop, they thought that was cool. And they thought that, man, if you can run this business, and you can run real estate. And then they would ask me, how is this pertinent to, real estate? And I was like, it's a business. So my pitch was this. So Tim, I met you in a conference. I would say, Tim, nice to meet you. And of course, I'm a relationship person. So I'm always building that relationship first. And I want to know, I'm not exactly a salesman, although I can be good at sales. I don't come up with a sales pitch right off the bat. I listen to exactly what you're looking for. And I would quickly figure out that Tim, had exited a business or he was in IT and he made a lot of money and he was looking for tax advantages, or he was just looking for a lot of money to put it into a real estate deal. And you had also told me that, you've done syndications or you had invested in syndications as an LP. And I'd say, okay, so what was the things that you didn't like about being invested as a syndicator and an LP investment? And he's like, well, I've always been kind of concerned. What if something happened on that property? Okay. And I would listen. And then they would say, well, sometimes I don't always get a return on my investment, quarter over quarter, month over month. Okay. So I would start to build my sales pitch. I was starting to build that relationship and I'd say, well, I have an interesting offering and mine's a little bit different. Have you ever heard of Blackstone? And he's like, yeah, I've heard of Blackstone. Have you ever heard of Sovereign Wealth? Yeah. So you've probably also heard of like Ameriprise or Edward Jones Finance. Okay. So I have a 506c fund to where I raise private equity to invest in multifamily real estate, mostly B's and C's and some A's. And I do exactly that. I do like Ameriprise or an Edward Jones, except I don't invest in stock, bonds, and mutual funds. I physically invest in real estate, real property, just the same as Blackstone. And another thing, although my fund might be called a syndication, it's a pool of properties that's put together. So it's a portfolio. So yeah, as we invest in the first one, it's a little bit scary at first because we're still working some things out. We're doing a value add strategy. But after we put second property, third property, fourth property, and we look to buy 7 different properties in this fund, I believe I can solve your issue and give you some security around getting a return. and solving the problem with not being invested in one single property or a single asset type in a single city. Really. And, you know, at that point, we would usually find a place to go to dinner or go to lunch. And then the conversation would just continue. And then they'd say, well, I want to hear about Eddie, because at the end of the day, although it's a blind pull, they were making an investment in Eddie Austin. So they wanted to know
Right.
what my business experience was, you know, what I had done. And at the time, I didn't have experience buying large multifamily properties. So the question would come up, how many assets under management do you have? How many how many exits have you done? And things like this. Well, I was new, so I didn't have any. I was like, I don't have any at this point. Well, how do you plan to do this? You know, you need experience. I understand completely. We're going to use third-party property management. I can also sign them up as a partner if I want to. And the biggest thing is my fund provides equity. And because I can provide equity, I can attract really good sponsors and operators to partner with me. And I don't want to do this alone. So I'll be looking to partner with certain people. And my boards of advisors on my fund, they have over 3 decades of experience in this environment, and they know what they're doing. And they're like, wow. And, you know, I'm not trying to toot my own horn here, but a lot of the times they would say, you've done your homework. Like, I'm impressed. You know, you found the things that I was concerned about with syndication, what I'm currently in, and you found a way around that. Very creative. So what did you do before this? I said, well, I own a metal fabrication hot rod shop. And then that conversation would continue and the relationship would build, and I would earn their trust.
Gotcha. Very good. I like that. I like how you tied them into Blackstone, tied them into, you know, Edward Jones and those type of, you know, yeah, brokerage house. And because that's what they're used to, right? Like that, you know,
Yeah.
we've all been, yeah, we've all been programmed for that. And so I like that. I like that tied in. And, you know, yeah, you know, from what I'm picking up, you know, your fund was a fund of fund structure. Is that correct?
No, so that was the thing. My
No?
fund was a straight raising equity to deploy it into, you know, our own deals. At the time, this was early 2019, and that I built this fund. I had done, you know, smaller real estate up until that point, and I had small door count, multifamily, stuff like that. But, you know, being in the big boy world, that was essentially new. So what I had found is there was people that would sign on loans for me, and there was people that had experience, but they were having troubles putting all the buckets together, having somebody good at asset management, having a sponsor. Well, my fund, what I found is I could actually put people on the team, and I could build a team with that because, you know, I was very good at finding deals. So I had good deal flow. So I had that figured out. And then I was good at raising the capital. So if I raised the capital and I had the deal, if somebody was just looking for signing on a loan, or somebody was looking for a place to asset manage beside me, you know, it was very easy to put that team together. I think Tim froze on us.
He just might have. Give him a second here to
Sure. I was afraid it was me.
I might just pitch in with a quick question. I mean, your original investors, and I don't know today, did they understand the risks of syndication versus funds? Because I think we all know the lack of transparency in funds, and then the need. It's obviously a lot of pressure on you as the GP to maintain performance on a fund with varying different assets that you have to manage and so forth. So how did you handle that?
So it come down to a lot of management software. You know, we had a very good management portfolio software that kind of gave reports, and it kind of tells you the entire story of, you know, how everybody's investment was. But one thing I learned very on in business is you always over communicate and leave nothing to be assumed. So from the point you're capital raising, always under promise, over deliver. be conservative with your underwriting, know your business plan, know your ins and outs. You're not going to know everything going in. That's why I don't like syndication. You're basically making a bet. You're going to roll the dice correctly 100% of the time, which is not life. And then from there, just communicating. When things go wrong, which they will go wrong, communicate that to your investors. Put it out there immediately, and just constantly be in contact with them.
Right. Okay.
Tell them the good, tell them the bad. Bad news doesn't age
Yeah.
well. Just deliver it.
I think that's sort of the root cause of a lot of failed syndicators that you see in the news. There's a few
Yep.
in Houston where I'm from, and yeah, you look into it is a lack of communication, and it's a lack of management, quite frankly. It's not just the variable interest rate that is causing issues.
100%.
Yeah, until we can get Tim back in here.
Okay.
Oh, there we go.
There's Tim.
Okay, I'm back. Oh my goodness. It's funny how like when things goes wrong, like it dominoes effects. Anyways, my phone overheated.
Oh,
Because I have in a case, but I removed the case now, so hopefully this works out. Sorry about that. So I'll ask the question again. So Eddie, was your fund a fund of funds?
no. So my fund was for the purpose of acquiring, properties, and we would sign on the loans. So at the time, fund of funds was not a huge topic. It wasn't hardly a topic at all. And with that, I knew that I was good at sourcing deals. I could find deals, and I knew that I could raise capital. So at that point, I just needed somebody that could asset manage beside me. I knew I needed a sponsor, and it was pretty easy to put those things together. If I had the equity and I had the deal, and I did the underwriting and everything else, I could do the marketing. So that part I all had figured out. So really what I needed was a sponsor. And if the deal was right, it was easy to find a sponsor. And, an asset manager, there's also somebody out there that can asset manage either for a fee or for money, by paying them. And they could easily be bolted into my fund.
Gotcha. That's a really bold move in terms of like starting a fund, yeah, without much of a experience around these bigger assets, and be able to raise that money and partner up with the operator. So let's go into that a little bit. Did you identify some operators ahead of time before you started raising money for the fund, or did you raise money for the fund first and then you went and looked for the operators? What was that order like?
Well, I'll tell you a secret. I might always not have it figured out when I start something, but I'll sign up for something big enough that I'm obligated to figure it out. And if it's not challenging, I'm not interested. So, when I started it all up, I figured a lot of things out on the fly. So as I was meeting people in conferences, I was saving business cards. I was making relationships with people that could operate, people that could asset manage. And what I also found is some operators on properties that we were looking to purchase, they would be willing to stay on as an operator, but they were wanting their equity back. So you could kind of recapitalize that opportunity.
That's very interesting. Okay. Now, so like in terms of the order, from when you started raising money for the fund, did you already identify some deals before you take on money, or did you take on money first? And also, did you take on the entire 24 million first before you started identifying assets, or give us some insights into what happened day one of the fund, day two, and so on?
Sure. So the first thing I did was I was underwriting tons of deals, 25, 30 a week. So I had my deal flow because I kind of had the buy box formulated. I had some pitch decks formulated for the fund on what type of assets it was acquiring. Cities, states, names, and addresses were bogus because, it was pretty hot in that time. So you didn't want to give out a document that had a name and an address on it, because if you weren't under PSA, somebody's going to snatch it up. So I kind of had that stuff figured out. I had already had deals picked, but that's kind of my buy box was formulated that we were going to buy X type of assets in X types of cities.
I see. Okay. And then, in terms of like um, uh, when you start to take in the money and deploying the money, did you do it in batches, or did you raise the entire amount first, or what was that process like?
So I wanted to raise the entire amount first, and that's essentially what I did. And
Oh,
I will
okay.
also say in my first fund, at the time that we raised all the money and we had everything ready to rock and roll, and we were ready to throw down on assets, I had done something that I never dreamed I would do, but I felt like it was the best thing to do. And this is probably going to shock each and every one of you. I decided to hand the $24.6 million back to my investors.
What?
Yep, 100%. So I was underwriting deals like crazy. Bridge loans was hot. Everything was ready to go. And at that time, I was looking at the numbers and I thought, this does not make sense. I feel like this is going to be a very risky investment because of the time. This was right before COVID. And these properties were very overinflated. Cap rates were compressed. And I can honestly say, when I called up my investors and I said, unfortunately, I cannot make sense of this market and I'm going to be giving your money back. I figured I'd be tarred and feathered. And they said, this is probably the most noble thing that someone's ever done, because you could have went out here and egotistically, pridefully handed the money back or, deployed the money and lost it. And because I know there was properties that I had under PSA that I handed off to other operators that wanted them, and those properties went back to the bank. So I am very proud to say, even though my first fund necessarily might have been a non-start, at the same time, we could have been in the news. Since that point, we flipped to syndicating. From syndicating, we closed around 220 million in around 20 months. And today, between me and my partners, we have close to $310 million in assets under management. And we have another fund that's open. So because I decided to stop and not do that, it allowed me, with the experience I had and the relationship that I had with my investors, to stop that and deploy it in other avenues and keep going forward.
That's such an interesting of what happened. So what was the time frame from the time that you give them back the money to the time that you start to deploy it on syndications or raise money for syndications?
We launched the fund 2019. We raised capital through 2020, handed it back around May of 2020. And at that point, I got involved with some other partners and they had syndications, and I was good at capital raising and putting things together. I had deal flow, and we just started making it all happen.
I see. Okay. Very fascinating. All right. So let's talk about, the building the community. I mean, a lot of us here, we attend events, we build relationship at events. How is it that you're able to, do the same thing, attend events just like many of us do, but yet having success in terms of actual capital raising from those events and from those relationships versus most people, come home empty-handed?
I think one of the things that's helped me the most is realizing my passion is helping other people. So even when I go in the room, the very first thing I do is I empty my glass. So say we walk into a hallway of Raise Fest and there's all these people in the hallway. They're standing out in front of the event. There's a ton of knowledge there. So I empty my glass like I don't know anything at all. And I educate myself through the room. And as I educate myself through the room on my way back, as someone talks to me, if they're missing something, I add value to that person. I educate them on something I just learned, or I educate them on something that I have knowledge in. So I was always an educator. I always added value. And by adding value, even like I've never invested in Bitcoin or cryptocurrency or blockchain or anything like that simply because I've never had someone explain it to me that I fully understand it. Like it's kind of like keep it simple. Nobody's been able to do that. So when I invest in real estate and when I ask people to invest in real estate, I educate them. They know exactly how this works. They know how we make our money. We know how we add value. I explain the whole process. And what I found was a lot of people never took the time to add value to people. And I was able to build kind of a following, a community with that, because a lot of people never add the value that was like, shake your hand. This is my name. Hey, Tim Mai, how are you? Can I get your contact information? And are you an LP? Are you accredited? And essentially that's kind of a turnoff. When it comes to building a relationship, it's like a bank. The first thing you're going to do is kind of interview the bank. You're going to find out if you want to put your money there or not. You're going to figure that out first. The next thing is you cannot withdraw any funds from that bank until you deposit something. And I watched everybody else in the room. All they would do is try to withdraw. First, they never knew if that was a person they wanted to withdraw from, and they never deposited anything with them before they could take something from them. I mean, you're going to add value to the person if you have a good full circle deal. But most people always went straight to the kill of like, hey, would you invest with me? I don't know anything about you. You're not Bigger Pockets. You're not Brandon Turner. You haven't been on podcasts. It's been worldwide notoriety, for the last 7-10 years, to where if Brandon Turner is looking for an investment, he's going to get it because people already know him. They like him. They trust him. They've seen him on the screen for, hundreds of hours.
Right. Yeah, that's so good. All right. What else do you do around community? So, outside of events, like what else do you do to continue to grow your community, nurture that relationship?
So always, every time I leave a conference, I try to make sure to connect with that person and stay in contact with that person. And I write down relatable things like Tim Mai had a Great Dane and he was a huge Great Dane fan, or, a favorite football team or something like that. So I would try to be like a person that had known you for 5 years or 10 years because I paid attention that much and I wrote things down. I made a good memory, and then I would email you, I would text you, I'd call you, and I would stay in your loop. So even though I might not have a community software where everyone was interacting, I was working my butt off being the hardest networker in the room by physically calling Tim Mai every 3 or 4 weeks or 5 weeks and saying, Tim, how you doing, man? How's the Great Dane? How's the family? I know your kid had a birthday last week. I was always that friend. That was how I built my communities.
Gotcha. Okay. So you go a bit deeper into
absolutely more personal.
Yeah. Gotcha. That makes sense. So, and then outside of events, so it sounds like events has been a really major in a way marketing channel for you to build your community, build your connections. Outside of events, what else do you do to grow that community?
Well, so I'm not afraid to talk to anybody. I'm an extreme extrovert. I have raised capital in hotel lobbies. I've met people in elevators, coffee shops. I'm good at listening. Good at intersecting quite, in certain things that are referrals. And, so anytime, I think my email list is around 15,000 people. And that's from back when the very start of business until now. Some of these emails and phone numbers were not people that were in real estate, but they had an interest of growing their wealth. And I knew that. So whether they were a business owner or a top executive, I always kept that dialogue. And I was always reaching out with those people, telling people what I was doing, getting on the phone with them often. So, and it didn't matter. I found a guy in Salt Lake City, and in Salt Lake City, he was in a hotel room. He was a truck driver. He owned a car lot in Des Moines, Iowa, and he had $300,000 in a self-directed IRA, and he had it not deployed, just liquid sitting in his IRA. And he wondered why I was wearing a suit, why I was wearing a suit, and why he couldn't get a motel room that night. And I said, well, it's probably because there's a big real estate conference. Is that why you're here? Yes, sir, it is. Well, what do you do in real estate? And I gave him my pitch about, Edward Jones and Blackstone and stuff like that. And he's like, oh, wow, well, that's really cool, but I could never have enough money to invest with someone like you. I said, well, $300,000, you could invest with me about 6 times. Really? And that was the thing, is I would listen and I would catch on. So I knew he had a self-directed IRA. So I knew that this was a person that could invest in my fund. And I knew that it was not deployed. So I would connect the dots and put it together.
Yeah. I love how you're always getting on the personal level, get to know them more. For the introverts in the room here, what are some of the ways that you would recommend as a way to, especially when you're opening up, talking to a complete stranger, so from what I'm picking up, you always start with them, and it's like, getting, finding out more about them. For the introverts who are not as comfortable talking to strangers, what would you recommend for them?
So the first thing I would recommend, that's going to be probably something totally different you ever heard. You probably started this fund, you're starting this capital raising and everything else. There's a purpose, there's a why. There's a big purpose behind this, and there's a why. And it's super important to you that this works. The bigger the why, the bigger the purpose, the more the introvert, in my opinion, goes away. I know a lot of friends that are introverts, and they get out here and they raise capital. They only do it for about an hour or two in a conference, and they're drained after that. But they give it their all for about an hour because their why or their purpose is so big that they can kind of forget about, they can go talk to 10 people, or they can go talk to 5 people, and they kind of sit back and listen to the room. The other way, is email marketing's big. You can get out here and you can collect a lot of emails, and you can add educational value to people. And, you don't have to get on a screen share unless you want to. You can kind of get people to know you. You can do podcasts by yourself and get them out there in the world and get people to know you. You can also send messages on Facebook and Instagram and stuff like that. You're not essentially sewing your face, but you can also put it out there that, hey, this is what I do. Is this something you'd be willing to talk more about? And, so there's introverted ways that I feel like, because my wife's an introvert, and I've got really good friends, I won't mention any names, that are also introverts in the real estate industry. And they do a very good job, but they realize what their strengths are. And they also realize that they got a battery for this stuff because their why is so big. They're going to do this because they know at the end of the day, they're going to retire their mom or their dad or their grandma, or, they want to end homelessness. There's a purpose tied to it. And therefore, because that why is so big, they can kind of put their introvertedness in the back seat for just 10 people or 5 people, or, they can go to a smaller event or smaller meetup, or maybe they never turn their camera on the Zoom.
Right. That's so good. Yeah. Tap into your why to help, sort of nudge you, right? Or
Exactly.
Motivate you to take the action that that's going to help move your business forward, getting out of your comfort zone. So I like that a lot. So you started raising in 2019, 2020, 21, 22. Now we're here all the way in 24. you have seen sort of different waves of how easy it is to raise money, how challenging it is to raise money, and a little bit of all of that. So share with us, like, from your personal journey there, what has that, what has that been like for you? And then now here in 2024, how easy or how difficult is it to raise money in this,
Yeah.
in today's,
In my capital raise experience, I can honestly say I have 20 years of it, because even before we did, a fund or a joint venture or an LLC, like a syndication, I was raising money to build or flip houses in 2004. We had raised, private money from friends or something like that, or joint ventures or tenant in common. So I've raised capital for 20 years now. And I can honestly say in, pre-COVID, 2015, 2016, money raising was easy, especially if you had a good deal. And I can honestly say nowadays, you've really got to lean on your skills, and you got to be on your communication skills, and you really got to educate people on, the risk that involved and how you're different than other people. Because, I've raised $1 million and 24.6 million in less than a month. And I've had to raise, close to 6 million in 6 weeks. And in the recent future, that was November of last year. And I can tell you that was one of the hardest things that I've done, even with my email list. It was very difficult. And that deal was 24.7% IRR, 33.2x or 33.2 average annualized return. It was a 2x multiple, 3-year hold. It checked every box for an investor in a 2023 deal. And it was still difficult. And to be completely honest, when my partners and I, we put it all together and we did the documents and we did all the math, I said, this will be easy. It wasn't easy. Not at all. Because the numbers were so good compared to other people that were raising capital. They were mid-teens on their IRR. And,
right.
At the end of the day, 33.2% average annualized return at a 2x multiple should have been an easy capital raise. Super easy for a 206 unit deal.
So what made it more challenging, would you say?
There was a lot of people, and this was surprising. A lot of people told me 3 years is too long for me. I don't want my money tied up that long. The returns are good, but I don't know. You still want to bet on multifamily in today's age? And I'm like, absolutely.
I get that a lot.
and then, our debt was 5.8%. And it was a 5-year term and a year to 2 years interest only. And, people are like, you're nuts, 5.8%. And I'm like, it's still lower than inflation. I don't think you understand the debt side of that. I'm happy to teach, but compared, even if it's 6.5%, 6.8%, it's still lower than inflation. The money's essentially free, because if you put your money in a savings account and inflation's 8%, if you're paying 6.6%, you're still making 2% on the money. And they were like, yeah, I get it, but multifamily is just too risky for me. And, it was just really surprising to me to hear that.
Yeah. But
here's the fun part.
interesting.
I also grew up and had been around people that laughed at 6.8% interest, because they're like, I borrowed money when it was 15 and 18%. And we made sense of real estate. We were still buying real estate. So, for me, I knew that this could be sold. This can be done.
Yeah, I remember back in 2009, and after after the market crashed in 2008, I met a guy that had started getting into multifamily, and he was buying, because banks were dumping properties during that time, and he was buying these properties using hard money lenders at 14%.
Yeah.
And yeah, and the numbers still worked,
Yeah,
and
it
yeah,
did.
it's really incredible how a lot of people don't realize that, the last yeah, I guess 10 years or so, the real estate market, the interest rate has been really low, but historically they weren't that low. Like if
No,
you come from if all yeah, if all you did was just come from the previous market, you would know, like, yeah, in 2000, 6, 2007, those, I think the interest rate then it was easily between 7 and 9%.
yeah,
So it
it
wasn't,
was.
yeah.
Yeah.
So very, very, very interesting. Okay. And then, so, with it being more challenging to raise, are you doing anything? What are you doing differently? Or like, how did you end up finish that raise there for that deal in November?
So we finished that raise out, and we decided at that point that and we were building our fund at this time. It was very frustrating for me because we were building the fund the same time we were buying this last syndication deal. Like, it was the last syndication deal ever. And it was the one that was going to make us remember it, And at the time, I was writing the narrative for our new fund, and I remember vividly going in my fund in the narrative documents and hitting the backspace on multifamily. And I backed it completely out. And I said, this fund will not have multifamily. I couldn't get my background to work quite right, but the name of this fund, this is one of the pictures for the fund, PPM behind me, and it's the Hampshire Diversified Fund 1. It has nothing, it doesn't have multifamily in the title at all. And it tells you what we invest in, and it's not just multifamily. Because I thought, we're still going to raise money. We're still going to do things in real estate. We're still going to get people returns. If they don't believe in real estate, we'll just build a more dynamic fund that people feel good about.
Okay. So you're planning to go beyond real estate with this fund? Or
So
just
not this
beyond?
particular one. So this is kind of a hybrid fund. So we can provide pref equity because this fund does just this. So it does RV parks. We also have over 50 years experience in raw land entitlement. So we raise money to do raw land. We do RV parks, and we do multifamily distressed and value add stabilize. On distressed assets, we actually look for partnerships with banks that will subordinate a certain amount of equity and let our fund come in as a Class B next to senior debt. And then we could put our LP capital in place, and then we would own the entire capital stack. And then we'd have a direct partnership with the bank. So our fund is not a fund of funds. However, it is a hybrid fund in the model that it can provide a pref equity position.
Right. Okay. And then what kind of returns are you projecting for the fund?
So it's about a 16 to 17% IRR, 2x multiple, 3 to 5 year hold on the lockup period. We offer a 10 pref, and we incentivize on the waterfall by invested amount. So if somebody invests 100,000, it's a 70-30. They invest $5 million. After the fund reaches 14% IRR, the fund will provide a 90-10 waterfall to the $5 million investor.
I see. Okay. And it is also a 506c fund?
It's a
Is that correct?
506c, 3C5 exemption. So it's real estate. 60% of its equity has to be invested in a real estate with debt. So it's not a private equity. So it has to be tied to debt.
Right. Okay. Very fascinating. Been through what you have been through and knowing what you know about this market, do you recommend the people that are coming in, especially coming in new, to do syndications or go straight into funds? Like, what would you recommend them?
I would highly recommend a fund. This is going to sound very salesy, but this is the God honest truth, in my opinion. Now is the time to educate. Now is the time to have a mentor, people that's been around, people that have some wherewithal, been around the block, been beat up a few times, admits their mistakes, stuff like that, and get a mentor, get a coach, whatever you want to call it, and build a fund. And syndications, in my opinions, are going to get smacked pretty hard. And they already are in the news. There's a lot of syndicators that got properties going back, and it's unfortunate. But let's be honest, Tim, when you do syndications, you have to roll the dice correctly 100% of the time, unless you're really, really good at under promising and over delivering. And, sometimes you buy properties and you find that asset management lied to you, or your property management lied to you. You find out that there's skeletons in the closet that's going to cost you a lot of money. And, you can do some of the best due diligence ever. I believe in my group wholeheartedly that we do the best due diligence on the planet, and we still make mistakes. And when you make mistakes, it's hard to turn around a syndication in 3 to 5 years when you make those mistakes sometimes, especially when they cost a lot of money. So in a syndication, you've got to be right 100% of the time. And I just don't agree with that. I don't think it's a true statement.
Okay.
So let's be honest. I'll take you down a quick road. So if you and I wanted to buy 5,000 units, so we're going to do, say, 13 to 14 syndications. Let's say 13 syndications, 350 units in size. We do 13 syndications flawlessly. Perfect. We're at 5,000 doors. We're pretty notable probably in the market. Well, people are looking up to us. We're getting better at raising capital. We got a little bit of a team. Let's see, we go out here and raise syndication number 14 or 15. And let's find out that there was people that were fraudulently hid inside the property. The rent roll was grossly off. Evictions were way off. Bad debt was way off the charts. There was aged AP, all of these things. Which one are you going to be remembered by? The 13 you did flawlessly or the one that you did wrong? Unfortunately, everybody looks at the one that you did wrong, because what happens is you're in a conference and people say, I invested with Tim and I'm not getting any returns. Me too, and stuff like that happens. So I feel like it's best for you as a sponsor, and it's best for your investors to put it in a fund and buy more than one property.
Right. Okay. So start a fund and get good with how to position and pitch that fund, basically. And focus, and it sounds like you focus a lot on the diversification aspect of it.
Correct.
Right.
Correct.
Awesome. All right, Eddie. For the folks listening that want to reach out to you, connect with you, partner with you, invest with you, learn from you, where would you like to send them?
So one of the easiest ways that I've found is throughout my years of doing this, I have formulated a hashtag that's especially for me. And it's hashtag Eddie Austin, AUSTIN BEX. And you can search that on Google and it should bring up anything I'm involved in. And then anything like somebody wants to invest. If you type in hashtag invest with Eddie Austin, you can find that.
Okay. Okay. Make sure you put in the chat for us. Hashtag Eddie Austin BEX. Okay, gotcha. Yeah, you know what? I had completely forgot about this strategy that you're using, and recently, I launched. I've been playing around with AI stuff, and I think I've cracked the code on how to get Bible videos going. And
really?
We'll be talking, just so everyone knows, we'll be talking a lot about AI marketing and capital raising at our event coming up, in September here. But just to kind of tease you a little bit. So since May 1st is when my team uploaded the first video. Now we have total of 6 videos. Our goal is to post 1 video per day. So by the end of today, there'll be a 7th video get posted. But out of the 6 video that has been posted since May 1st, 3 of them has gone viral.
Wow.
Meaning that they have gotten those 3 have gotten over 5,000 views just in the last few days.
Wow.
And and then now I realize the importance of having your name as a hashtag. So now all of those videos I hashtag Tim Mai. Good. Luckily, my name is unique enough that I can hashtag just Tim Mai and it would work. So pretty soon I'm gonna have hundreds of videos out there. So whenever someone Google, hashtag Tim Mai or search on any platform, hashtag Tim Mai, they're gonna see a ton of content that I'm putting out. And the cool thing about it is that they're all created by AI. They're all AI content, but they're really good content. So
Very cool.
yeah. But so hashtag Eddie Austin BEX, and then that takes people everywhere else, right? Okay, awesome. All right, Eddie. Well, we're gonna wrap up this portion of our show today, and then we'll open up for Q&A. Thank you, Eddie, so much for being on this interview with me. Really appreciate you. You've been a wealth amount of knowledge. You have a very interesting perspectives, and I really appreciate that. Thank you so much.
Likewise, my friend. It was an honor.
Awesome. All right, everyone. Q&A time. Now, before Q&A time, I want to officially announce. I touch on it, but I'll officially announce our capital raising. It'll be our capital raising and AI marketing summit that we're hosting here in September in Houston, September 19th to 21st in Houston. And at the event we just did last week in Dallas, the AI sessions were like the most fascinating one. I think everyone was very glued, very engaged on those sessions. We went through a ton of different new AI technology. So I'm really gonna lean heavily on AI moving forward with a lot of different things that we do. So I'll be sharing that along the way. We have a special going on right now. So we'll put it in the chat for you guys to join us. I know it's a little bit way out, but it's best to sign up now so that way you can get the discount. Plus, if you want to join us on our ambassador team, meaning become an affiliate, we're paying a 50% commission. So what that means is that all you have to do is refer 2 people. Your ticket would be completely free, and then plus you can make a lot more money as well. So let us know if you want to be a part of that. All right, who has question for Eddie? Raise your hand. You have a question for Eddie? Go ahead and raise. I'm on my phone, so it's a bit difficult for me to see, but just do your digital hand raise, okay? Definitely don't do the physical hand raise because I would not be able to see you. I can only see a few people at a time. Okay. All right. Let me see here. Yukiko asks, which lawyer did you use to create the fund?
So we use Regulation D Resource, which is now Red Rock Securities Law.
Okay.
Highly recommend Doug Ruark and his team. Very, very good. They treated me with true fashion, and they were very professional.
Very cool. Yeah, there's a lot of SEC attorneys out there. It's definitely always good to know when someone has been through, used them and have personal experience. All right, Derek, go ahead.
Yeah, I'm wondering, you mentioned IRR before. What do you find as a metric that LPs take seriously? Because I think we all know IRR is one of the worst metrics. You know, it can easily be manipulated. You can play around with your capital spend, push it back, you know, bring returns forward, and suddenly your IRR jumps up, blah, blah, blah. Many ways to do it. Do you find there's any, you know, obviously the simple ones, equity multiple within a certain time range, but do you have any recommendation what people are looking
So
for?
back in the day, I highly recommended IRR because it was an internal rate of return. And now today, because that number essentially is a lower metric in your table of capital raising, arsenal, on how to tell people what this opportunity will make them. So a lot of the times now we use an average annualized rate of return. So when the AAR or annual rate of return, whatever the higher number is, that's what we use. And then we always use the equity multiples because it's easy to explain, it's a 2x or a 3x. So if you invest 100, you'll get 200 back.
Okay. Then the other quick question, I'm looking right now, planning to develop an RV park, and I want to sort of split the raise, some debt, some equity. Have you got experience, or how do you see the market responding? I think you mentioned some people want a little bit shorter time frame, so you could literally have them come in as debt investors, and at the refi in say 2.5, 3 years, they could be cycled out and the equity investors remain, for example.
Yeah. So honestly, you would have to do both. You'd have to do a private equity style fund, but even then you have to make an exemption on whether it's a debt fund or an equity fund. So most likely it could not be both. So you would have probably two separate opportunities investing in the same. And then also you'd have to be very careful that none of your own money is invested in the opportunity if you're the fund manager of that.
Right. Okay. I guess I was probably thinking doing it as a syndication rather than a fund, but that's good to know though. So thanks.
Yeah. And you could.
Yeah, it would just be different class of shares, I guess, in a syndication versus a fund to be a bit more complicated. So.
Yep.
Okay. Thank you.
You're welcome.
Awesome. All right. Who else? If you have questions, can raise your hand, and if not, we can do a breakout session. So, Eddie, you have some extra time to hang out with us in the breakout session?
Sure. Yeah, I got a little bit of time.
Okay. Okay. Cool. Well, yeah. So we'll go ahead and wrap up this part. I don't see any more hand raise that I can see of. So yeah. For those of you, Logan, for those of you who want to connect with me in any capacity, whether it's fund-of-funds opportunities, GP, LP opportunities, want to learn more about our Hero Alliance group, reach out to Logan Price. He'll put his contact information in the chat there for you. And we'll get connected. Everyone, turn on your cameras. Let's do a group picture real quick. Turn on your cameras. And I'm sure Eddie knows how we do our pose here, right, Eddie?
Yep.
All right, everybody ready? Everybody got your cameras on? Come on, don't be shy. All right. All right, guys, you guys ready? 3, 2, 1. Yay, awesome. Okay.